covering news that matters. Fox 23 News at 6:30 starts right now.
Thanks for joining me at 6:30. I'm Rick Maranon. Tonight we're going in depth on tariffs. You've heard a lot about them lately. I asked a nonpartisan financial expert to come on the show and talk to me about what these things mean for you and your family in the months and years to come. Back on the program is BOK Financial Chief Investment Strategist Steve Wyett to talk unedited in his own words. I know on the campaign trail, the definition of a tariff had kind of been distorted. Can you define for the viewers just what a tariff is before we start talking about them?
Sure. Well, in short, a tariff is just an additional fee that we're going to put on an imported good. And tariffs are used today, Rick. That's we have goods that we export to other countries that they put tariffs on that. In fact, that's a big part of what we're looking at right now is this idea of reciprocity, where President Trump is coming in and saying, look, other countries have full access to our markets. We'd like similar full access to your markets. If you're not willing to do that, then we'll put tariffs on your goods that you're importing into the United States. Now, that's part of it, but ultimately it's just an additional fee that we're putting on an imported good to be sold in the U.S. market.
How heavy will I feel this once these new tariffs kick in? Is it going to be a huge or I mean, we've already dealt with inflation, so we're kind of leery as we're already.
And that's the big thing that we're sensitive about is, look, the last thing we need is something that's going to increase prices even more. That's not what any of us want. So the fact of the matter is, Rick, though, we don't know for sure. Now, part of it is how big is the tariff that we're going to put on imported goods. So recently, you saw President Trump say, hey, we're going to slap a 25% tariff on imported goods from Mexico and Canada. That's so if it was a blanket tariff, then the cost of every good coming in from Mexico or Canada could go up by 25%. The reality of it is we don't know exactly how the companies are going to act. Sometimes they'll eat part of that tariff. They'll reduce their margin. How consumers respond is a big question mark as well, because if that happens, then we just won't buy the goods imported from Mexico and Canada. We'll buy substitute some other good that maybe is made here or is from a country that we're not tariffing. So this is one of the hard parts as we think about the simplistic definition of what a tariff is and then the impact on the economy. So much of this is how the tariffs are implemented. Look, we put tariffs on, and I think this is an important point. We view what's happening with tariffs now as primarily a negotiating tool. This is President-elect Trump trying to negotiate with other countries to get some things done. Because if we think about the threat of tariffs on Mexico and Canada, that was less about their importing goods. It was more to get them to do things from a societal standpoint, slow the flow of illegal immigration or help us with the flow of illicit drugs into the United States. Helping those governments or trying to give those governments a reason to help us along those lines. And that's different than if we're just talking about China, which that is more of an economic kind of, we import a lot of goods from China and we want to see more of those goods made here in the United States. But here's how you make a negotiating tool effective. You're willing to do it. And that's where the experience of President Trump in his first administration, where he actually did do some tariffs. And by the way, the tariffs that we put on China in his first administration in 2018, they're still in place because the Biden administration kept those in place during that period of time. Now, what's kind of interesting about that, we did go back and look at import prices overall during that period. They actually did not go up during that period. So it wasn't necessarily inflationary in the first run of tariffs. What this next one would look like, a lot of it would depend. The devil's going to be in the details on how it's implemented. But in general, that would you'd think that consumers would be paying higher prices for goods than if they weren't tariffed.
One of the reasons I wanted to talk to you is we do have data that shows even if consumers aren't buying, they are considering buying electronics right now.
Yes.
They're at least thinking about it. Mm-hmm. Should I go ahead and my phone is okay, but if I think I need an upgrade in a year, should I do something as simple as shopping for an electronic like that right now? I've already missed Black Friday and everything else. But,
Look, I often say if we could figure out how to live on flat screen TVs, we'd be fine because flat screen TV prices are plummeting. They're really getting cheap. So, in general, electronics have been kind of that's a disinflationary part of what we're doing. Here's a couple of things I would consider. One is let's remember that these tariffs are not implemented yet. And if they are, it's going to be later in 2025 before that happens. We don't know the amount of the tariffs. We don't know the goods that are involved. So I've read some of the same stories you have about consumers thinking about, okay, what goods should I maybe be stockpiling? I would just say that you're taking a bit of a chance there. You might be stockpiling a good that's going to get cheaper over time anyway, and it may end up not being part of a tariff action. That would be it would be difficult for me to say that that's necessarily a prudent economic decision to start stockpiling some of that stuff.
I know you don't have a crystal ball, but if I had to ask you, do you think next Christmas will be more expensive in the way of goodies because of just what we know today?
Well, let's put it this way. Look, when we talk about inflation getting better, and we got a CPI report out this morning that showed that inflation still, it's still with us. And it's lower than it was, but that doesn't mean goods prices are going down. That just means they're going up more slowly. We still anticipate there's going to be some inflationary pressure as we move through next year. So I think overall, yes, the cost of living is still going to be a little bit higher by next Christmas. But there are going to be certain goods that may be a lot cheaper by next year than they are this year. But in general, price levels overall in our economy, Rick, are still going up. Tariffs aren't going to bring that down. That may add to that a little bit. So if you're asking me, yes, I would count on Christmas next year being a little bit more expensive, just like Christmas this year is a little bit more expensive than last year.
Do you have any data about car shopping in this environment? Because we do have domestic producers, but we also have foreign producers as well.
Sure.
I imagine cars will get caught up in this. Is that correct?
Yeah, it will. In fact, that's a big area of reciprocity because most of the European car manufacturers have open access to our markets. U.S. manufacturers, they charge a tariff for U.S. cars in Europe. So this is where that idea of reciprocity is kind of coming from. It's not just China. It's not just Mexico or Canada. Europe is involved in this as well. The auto business is a huge part of our economy. And yes, we want equal treatment of those goods in other countries. The other part of that, though, Rick, is just that in the CPI report, new and used car prices were up a little bit more than we were expecting. Even though it does look like supply chains have pretty well healed, you've still got goods pricing a little bit firmer than what we were anticipating. We had a couple of big hurricanes in the southeast part of the country. I'm not totally surprised that used car prices firm a little bit. There's a whole lot of cars that need to be replaced in the southeast part of the country. But overall, supply chains are healing. And here's what we do see. While car prices may be a little higher, man, the ability to get low rate financing or other types of incentives to purchase a car are a lot more, they're a lot more likely to do that now than they were 12 or 18 months ago.
Steve, is there anything else you'd like to mention? I appreciate your time today.
So, Rick, I think that this tariffs are certainly a big question mark as we move forward. As we think about the big policy changes that we may see, the implementation of these is going to be really, really important. There's some additive parts to it. An easier regulatory environment could be additive to growth into 2025. Tax policy, where we're now looking for an extension of the Tax Cuts and Jobs Act and Social Security, maybe even lower corporate taxes. That's additive to the outlook for growth. But then these areas around immigration, which could impact the size of the labor force, or tariffs, these are potential headwinds for growth. So there's a lot of moving parts as we move into 2025. The capital markets have taken a pretty positive outlook on growth in 2025 going forward. But there's some areas we're going to have to watch how this implementation is actually put in place that could play a big part in what the actual outcome is for the economy and the markets in 2025.
Real quick before we go, are tariffs an act of Congress, or does the president have the ability to do it on his own, or is it a mix?
Yeah, it's a good question. Some of both. And in fact, when you think about Mexico and Canada, there are some questions about how much President Trump could actually do there, because we've got trade agreements that are that were passed by Congress between some of our trading partners. And so there is some question about what we can do from a tariff standpoint there. But there's enough room there for President Trump without Congress to make some moves that could impact the trade agreements or the trade arrangements that we have between countries.